Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. A minute to go until the start of cash equities trading. Here are your headlines. The reflation rethink continues in the wake of a hawkish pivot by the Fed. European and US futures slip with Asian equities. Treasuries flattening. 30-year yields fall below 2% for the first time since February. Front-end yields pick up on comments from the Fed's bullard. And nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee the US won't quit the accord again. Oil climbs. Good morning, everybody. Let's take a look at these futures then for European equity markets. We've been tracking the flattening of the curve, so we'll keep an eye on the bank stocks with that in mind. Certainly a great deal of action along the 5s, 30s curve. The same story as last week to some extent, but certainly supercharged through the Asian session overnight. Asian equities were weaker, down by 1.5% at this stage. So we'll continue to focus on that flattening of the curve, what that means for other assets. And we certainly see money coming out of equities through the Asian session. And to some extent, we're expecting to see that a little bit through the European session as well. Futures, as we saw there, were pointing to the downside, and a negative start to trade is what we're seeing. The stock 600 just reflecting the FTSE really this morning so far. So the FTSE 100 down by 0.4%. The IBEX now opening down by 0.7%. The stock 600 down 0.25%. I've mentioned banks. That sector's going to be in focus. The mining stocks will also be very much in focus. We saw iron ore lose more than 4% at one stage during the trading session through the Asian session. So that's certainly in focus for us. The CAC 40 opening to the downside as well, down by 0.7%. And in terms of the equity markets, we're really questioning the reflation trades once again. So something that we saw at the back end of last week, certainly continuing through the Asian session, through the Japanese equity markets, and carrying on once again into the European equity market session. As I mentioned, the CAC 40 opening 0.7% to the downside. So we're down by a similar amount on the stock 600, waiting for the DAX to open this morning. So European equity markets opening decidedly lower. Investors sour on those reflation trades after that hawkish pivot from the Fed. Stocks slide with Japan's Nikkei leading declines through the Asian session. The 30-year Treasury yield drops below 2% for the first time since February, so that's very indicative of that flattening curve that we've been talking about. Viraj Patel, global macro strategist at Vanda Research, joins us. Viraj, what is the significance, do you think, of the flattening of that yield curve and the impact it's having on other assets at the moment? Does it fit with your view of where we head from here?
Yeah, broadly, I think so. I think, we've been calling for the reflation trade to unwind for a month now. And I think we're starting to see the early signs of that. First, from a positioning perspective, most reflation assets, anything that's an inflation hedge, has been fairly crowded. And that's usually a good starting point. But the second thing that we've noticed, and there's two legs to this unwind. First is the peak in the inflation narrative as we work our way through those base effects and one-time reopening effects in terms of price implications that will naturally keep a lid on inflation expectations. And the second thing is that central banks, especially those in the US and China, are telling us that actually these sort of unconventional, easy monetary policy conditions that we've been used to for the past 12 months aren't likely to exist forever. But it's worth remembering that the central banks aren't slamming the brakes here. All they're doing is taking easy monetary policy from fifth gear down to fourth gear. And really, for us, that doesn't mean anything other than just an unwind in the reflation trades, but a pretty constructive view for growth and having a growth bias across the portfolio and asset allocation perspective. That's one of the reasons why we like US tech stocks here, US growth stocks here into July. We think the conditions are pretty good for that.
Okay, and we're seeing the flattening of the curve kind of spreading. So something that was very Treasury-centric to start with, and now we see the start of the UK gilt session, of course, and the UK 30-year yield falling below 1.2% for the first time since February the 18th. So it's the first time since February that we're seeing these substantial moves at the 30-year end of the curve, Viraj. Just thinking about what that flattening then means for European stocks. You've been questioning the consensus overweighting European equities. Was that because you kind of saw this coming? You thought that maybe we shouldn't be buying up value stocks, we shouldn't be buying up the reflation stocks to the extent that others in the market thought we should be?
Yeah, very much so. I think it's twofold. I think first, from a positioning perspective, again, things like European banks, materials, resources, energy, they're fairly crowded, and they have been for good reason. Obviously, we've had a rising yields environment. Those sectors do really well during that time, but a pullback was inevitable given the sort of turn in the inflation sentiment and the likely pullback in yields driven by just systematic short covering as well as a turn in fundamentals. So I think this was all expected to some extent. I think the second reason just challenging that overweight is really question marks over, as I mentioned, the cyclicality as well. And I think we're starting to see some of the higher frequency data points that we watch in Europe starting to fizzle out in terms of momentum. And I think that's ominous in terms of just how the next phase of the reopening story is likely to play out. Well, probably the easy part is behind us. And actually, we're probably now, as we're seeing in the UK, but also in other on continental Europe, the slow grind towards normal is likely to continue. And that may be more than just a month story. That's going to be 3 to 6 months, if not longer, before we get back to some levels of normal activity. So I think that's just a reality check on the whole story. A pullback was necessary. Valuations aren't as cheap as they were 3 months ago, and I think that augurs towards a growth versus value tilt for us.
Okay, so still a growth versus value tilt for you, Viraj, then over at Vanda Research. Thanks very much. Stay with us. Viraj Patel from Vanda Research with us a little bit longer here on the European Market Open. Coming up then on this programme, we take a look at the events you need to watch out for this week, including a final swan song for the BOE's biggest hawk. We'll talk about the UK market. I just mentioned what's happening with UK 30-year yields, so as gilt yields falling below 1.2% for the first time since February 2018. Things very much on the move as we wait, as we pick up the lead from the Treasury markets on that front. We'll get to that conversation shortly. Also, we'll keep an eye on the supermarkets here in the UK, continuing the UK theme. Morrison's up by 30% this morning on bid activity. That is supporting the rest of the supermarket sector here in the UK as well. Sainsbury's and Tesco's also on the rise to a lesser extent. We'll get the details on that shortly too. This is Bloomberg. Welcome back to the European Market Open. Just coming up to 9 minutes into our European trading session, and this is the picture for stocks this morning. We're weaker. We're down by 0.7% on the Stocks Europe 600. The FTSE under pressure, as you can see, down 0.8% this morning. Let's take a look at some of the sectors or some of the stocks that are on the move in one particular sector, and that is grocery retail. Morrisons, share price of Morrisons up by more than 30%. They've rejected that bid that they received from CD&R, but that got lots of people talking about whether others might come in to bid for this kind of asset. There are real estate assets attached to Morrisons as well, which adds another dimension that not all of the supermarkets have. This is to some extent rubbing off then and lifting others in the sector. Sainsbury's and Tesco both trading higher, and this is a sort of extra special achievement, I suppose, on a day where we see European stocks very much in the red. More broadly, the FTSE 100 down by 0.8%. Let's take a look at some of the things that we're watching out for then this week. It's going to be a busy week. Bloomberg is live in Qatar, presenting the Qatar Economic Forum, speaking to the WTO Director General, the Barclays CEO, and the Bridgewater founder, Ray Dalio. So plenty of big names on the agenda there. On Tuesday, Fed Chair Jay Powell testifies at a House hearing on the Fed's pandemic emergency lending and asset purchase program. How happy is he about the way that the markets have responded to the Fed's statements of last week? If he wants to issue any sort of corrective commentary at all, then we'd look for that this week. On Wednesday, we have PMIs from the US and also from the euro area. And on Thursday, the Bank of England MPC will announce its latest rate decision. Of course, we're saying goodbye to one of its biggest hawks soon. And in the United States, the Fed releases the results of its stress tests on the large US banks. And in Brussels, EU leaders gather for a summit to discuss the pandemic, recovery, migration, relations with Russia and Turkey. So it is a jam-packed week, a packed agenda in terms of things to look ahead to. Viraj Patel from Vanda Research is still with us. Picking up on one of those then, Viraj, we've got an MPC meeting, we've got a meeting of the Monetary Policy Committee at the Bank of England. What are you expecting in relation to the hawkish narrative we've seen of late coming through from the Bank of England? It's been quite driven.
Good morning, traders. Hope you had a good weekend. Right back to the business. I'm going to place an order for Japanese yen. As you can see, we hold short position at 110128. Right now, I'm going to place an order to sell, if it will change direction, to 110028. Okay? So if you followed my trade, if you copy this trade, you need to place the order and stay with me. And you're already in profit right now. So let me find the position where we're going to sell. 038, just right here, as you can see. Oops. Okay, and if you remember, if you follow the trade, we sold short Japanese yen at 110128. It will give us £1,000 in profit. In your case, it's all about how much money you pay per contract, right? So I'll just point out for new people who just arrived that in some countries it's the early morning, so some people still in bed, but Forex market never sleeps. Okay, 110128, this is where we sold short Japanese yen, and this is the price where we're going to sell if it will change direction. 110028. Okay, it will give us 10 pips. In our case, it will give us £1,000 because per pip we make £100. In your case, you had to check with your broker how much he pays you per pip. Okay, I'll speak to you later, guys. Stay safe.
Unknowns and the furlough scheme, how will that come to an end later on this year? So if the Bank of England wants to avoid the appearance or wants to avoid in markets any premature tightening at the short end, that makes me think about what's happening in M&A. And of course, we've seen some big news around M&A, around Morrison's in the supermarket space over the weekend. I don't know if you have thoughts on that sector in particular, Viraj, or more broadly around the M&A story. If we are going to see a higher rate environment to come, is that going to mean a flurry of M&A, rushes to get done before rates pick up, or is it already too late for that?
I think it's natural to start hearing more stories around mergers, especially given the stage of the cycle that we're in. So I think we could expect more stories like this, not just in the UK, but across Europe and also in the US, providing a bit of support for stock markets over summer, especially amid thin narratives. And I think that's probably something to watch out for investors. But as I mentioned, it's natural to see this at this stage of the cycle. A lot of companies will be looking for bargains and opportunities to take this low rates environment as it is, especially before we enter the sort of mid-cycle phase and a period where growth is likely to come harder and also rates are likely to increase.
Viraj, thank you very much for your thoughts. Viraj Patel, Global Macro Strategist at Vanda Research. Thanks very much for joining us. Coming up on the programme then, warnings of a third wave of coronavirus in the UK and what that could mean for international travel. We'll talk about that next. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the European Market Open. European equity markets under pressure. The Stoxx 600 down by 0.6%, off lows actually perhaps for some of these markets. But the leadership in terms of the downside being handed over from London to elsewhere. Now we see other markets losing more ground than the FTSE 100. Now the rapid development and efficacy of COVID-19 shots from Pfizer and Moderna have created sky-high expectations for the novel messenger RNA technology that they both use. The Pfizer chairman and CEO, Albert Bourla, says the success is due to big R&D and tech pushes that started with his predecessor, and that his company is well positioned to tackle other unmet medical needs once the pandemic is over. He spoke exclusively to Bloomberg's David Weston.
I wouldn't say I knew I can do it, but what I knew is that I have to do it.
because I would realize that the consequences, if we fail, will be dramatic. And although I have high respect for everyone who tried, I knew that very few will have the dedication that we are having. So in a sense, I was feeling that if it is not us, then I'm afraid no one else will find the solution. And that was not an option. So I treat it like if that's it. We do it and we have to do it.
So as I understand, you had repositioned the company some when you took over as CEO more toward basic science and some of the high-end drugs, high-risk, high-reward drugs. So you may have been better positioned for that. But as you looked at the problem, what alternatives do you have? What tools did you have in your toolkit saying, I have to have a vaccine, how do we go about doing it? Because you ended up with mRNA, but that was not the only alternative.
Yes. First of all, let me say that I did reposition the company when I took over in 2019, but only because of the work of my predecessor. It's not because we have a new sheriff in town. He worked very hard to turn around the R&D. So when I took over, I found an R&D machine that I could believe. And this is why I took all the risk to say that let's find better homes for other businesses and let's focus on the science. Another thing that we did when we said let's focus on science, I knew that in biological science, equal importance with biology has now digital. And that was the time that we brought for the first time a chief digital officer at Pfizer. And we dramatically increased the investments in R&D and in digital. The digital infrastructure that we built in 19 and in the first half of 20 was what helped us dramatically to make this vaccine work. A lot of these things would not be possible unless we have this seamless machine that had digitized our clinical trials.
So, Dr. Bohr, let's talk about the future here. What comes next for the world, for your industry, but for Pfizer in particular? Let's start with Pfizer. Obviously, you've accomplished something that nobody thought you would accomplish. It has really helped save the world. I don't think that's an exaggeration, actually. Where do you go from here? I mean, you're at a pretty high point. What's next for Pfizer?
I think the fundamental question that comes to me after this great success, it is if we were able to do it for COVID, why not for cancer? Why not for Alzheimer's? Why not for many other diseases that they require treatments? That's in general for the industry. And ourselves, we are focused on 6 therapeutic areas that they are covering a broad spectrum of medical needs, most of them unmet right now. So I think there is some lessons learned and thinking out of the box and re-engineering your processes and investing in R&D, creating a culture that can do the impossible possible, and investing in digital is key for the success in bringing new breakthrough innovations to the world. So this is what I think you will see from Pfizer in the next few years, more breakthroughs that change patients' lives.
Where are we going because of the pandemic? In this sense, will we be able to travel the way we used to? Will the cities come back with the vaccinations? Will it actually get us back to something like what was normal? Or will we really perpetually be living in a somewhat different world going forward?
I believe in terms of controlling COVID, I think we will be able to control it to a level that we could have, if we wanted, our whole life back. But I think there were some lessons learned. Lessons that, for example, we can work remotely as good as by coming to the office every day. I don't think this will go away. Lessons that maybe you can do Zoom instead of travel for a business trip that will take you 2 days just to go and come. That I don't think we'll see coming away, not because of COVID, but because we learned that we can do it differently.
Really interesting conversation there. The thoughts of the chairman and CEO of Pfizer, Albert Bourla, speaking exclusively to Bloomberg. Let's stay with the fight against COVID, because despite the best efforts of Pfizer and others, there's still a battle to fight. The UK government is signalling it will keep restrictions on overseas travel as concerns grow over a third wave of coronavirus. That's despite 60% of adults in the UK now being fully vaccinated. Joining me now is Sam Fazeli from Bloomberg Intelligence. Sam, another week and the battle against the Delta variant, of COVID-19 goes on. We've had some warnings over the weekend from Public Health England about new measures that might or might not be needed over the winter. What more are we learning about Delta and the fight against it?
Yeah, good morning, Anna. So nothing really new on Delta specifically. I mean, you know, the variant is showing that it is indeed more transmissible The cases are occurring clearly a lot more in the unvaccinated people. If you look through the Public Health England data and the ZOE database that tracks people, are happening in unvaccinated people versus vaccinated. A big difference there, which is exactly what you want. The problem is that you do also see a breakthrough in vaccinated people because the virus is a little bit better at infecting people despite the vaccine than the alpha variant. So these are things that constantly change and new information comes to hand.
And so I suppose we're still waiting to find out how much an uptick in cases matters, because we're waiting to see how much we have or have not broken the link between infection and hospitalization and death. And it might be very different at different age groups, given the levels of vaccination are very different at different age groups, Sam.
Absolutely right. That if our entire aim is to reduce death and hospitalizations and reduce the pressure on the NHS, then that link, I'm pretty sure, will have been broken, but clearly for the vaccinated as opposed to the unvaccinated, which if the virus is a little bit more able to increase hospitalization versus the alpha variant, you do have a problem that you're going to start seeing more and more younger people.
And where else should we be keeping an eye on this Delta variant then, Sam? We've talked before about how it's very much less prevalent in some other places, but it is rising quite quickly in some places where we see it. So in the US, in Germany, in Portugal, maybe a focus on further afield as well. Where else are you particularly nervous about? Because this is a real warning, isn't it, the UK story here, because we have high levels of a speedy vaccination, and yet it is difficult to take on this new variant.
Yeah, so Anna, I think the way to think about that is Israel, at around the 50% full vaccinations, managed to break the back of the alpha variant. Now we have a more transmissible variant that automatically suggests that you should need, or you would need, a higher rate of full vaccinations. 60, 70%, I don't know. Now, no country, apart from some of the smaller countries around the world, are at those sorts of levels. And then, of course, that means that if you're in the United States, Europe, European Union, you need to worry about it, and therefore vaccinate as fast as you can and minimize cases as much as you can so that you could get to that equilibrium.
Okay, Sam, thanks very much. Sam Fazeli from Bloomberg Intelligence. I was interested in some research by Bloomberg Economics over the weekend, seeing the risks to the outlook from the Delta variant and running some numbers essentially on what that would mean if it picked up elsewhere. Coming up, we'll be back to the oil story and some geopolitics as well. Around 6, but still no agreement in sight for the Iranian nuclear deal. This as Iran elects its hardline cleric Ibrahim Raisi as president. More on that next. This is Bloomberg.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into the first trading session of the week here for European equities, and we are down by 0.6% as we continue to question reflation trades, it seems. And if we look at what's going on from a sector perspective, it gives us some really interesting insight. There is one sector that stands out to the upside: personal consumer, discretionary and grocery stores. And it is the GS, it's the grocery stores that are really lifting things, although this does go wider, and we have, to some extent, gains for many names in that sector. But it's the grocery stores doing well, with Morrison's trading higher by more than 30%, up by 32% right now. That's part of the reason we're seeing such a strong performance for that sector. Down at the bottom, basic resources, no surprise there that we see that sector under pressure, with iron ore down by more than 4% in the Asia session. The banking stocks, as we flagged before the start of trade, not liking, of course, the flattening of that yield curve. Travel and leisure, interesting to see that sector is moving to the downside. We have the likes of EasyJet and Ryanair and IAG, so all of those down by more than 2.5% in session. A real focus on the woes, the travails of the travel sector once again. Let's get a Bloomberg First Word News update. Laura Wright is here with that. Good morning, Laura.
Good morning, Anna. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's National Rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. Some of Japan's biggest private employers will offer on-site vaccinations for staff from today in an effort to boost the country's slow vaccine rollout. Elsewhere, Russia, Germany and Portugal reported more cases of the Delta variant. Canada, meanwhile, said its border with the US probably won't reopen until 75% of its population is vaccinated. UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness almost £15 billion of annual R&D spend to find solutions for the public good. The new Office for Science and Technology Strategy will be headed up by the government's Chief Scientific Advisor, Patrick Vallance. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thanks very much. Laura Wright here in London. Now, the sixth round of talks in Vienna between Iran and world powers did not produce an agreement yesterday, and the election of the ultra-conservative cleric Ibrahim Raisi as the country's next president could pose a new test. Let's talk now to Simone Foxman, who's been following this story for us. And Simone, what impact then are we already seeing, or do we expect to see, from the hardline of the new hardline president elected in Iran? This is all to do with trying to return us to the 2015 nuclear deal deal with Iran, but it's proving difficult. And is it complicated, I suppose, by the election of a new president in Iran?
Yeah, well, certainly this does add a new flavor of concerns, particularly to things that the United States wants. The what's called longer and stronger deal that the likes of Antony Blinken have talked about, essentially going beyond that original nuclear deal struck in 2015 with something more between the United States and Iran. That's something the new president who will take office in August is likely not to be as receptive to as the more moderate Rouhani, who wasn't, frankly, very receptive to that necessarily at all. But, you know, when we look at the markets, when we look at oil prices today, we initially saw these climb as sort of analysts added to doubt about the timing with which Iranian crude could return to the market. But we've seen oil prices sort of retrace themselves, and maybe that's a reflection of the overall idea that not only was Raisi expected to win this race, but also that the return to that JCPOA agreement is still what experts on this expect, more likely than not.
So what is it that's standing in the way of that return to the JCPOA then, Simone? What are the sticking points that are currently keeping these, well, the US and Iran on different pages?
Yeah, you know, Anna, it's funny, but this, I mean, maybe not funny, maybe sad perhaps, but the sticking points are sort of the fundamental problems. Iran specifically wants the United States to commit that it's not going to, in the next election, a new Republican perhaps coming into office, suddenly turn around and go back on this deal. That's something that is challenging for the United States to do. The United States wants a broader agreement, ultimately, wants this 2015 nuclear deal, a return to that, to be the entree for some broader discussion of Iran's support for regional militias, of its human rights violations, and that's not something that Iran's necessarily so willing to give up. What we do understand, though, is that there has been some progress in terms of which sanctions might get repealed if we saw that return to a deal. If you recall, the Trump administration imposed something like 2,500 different new sanctions, not all tied to the nuclear program, some tied to human rights, and it's just been challenging for the U.S. and Iran to sort of pick apart which ones go back and which ones remain.
Simone, thank you very much. Bloomberg's Simone Foxman with the latest on Iran and trying to restore the Iran nuclear deal. Coming up then on this program, bubble trouble. Some of the world's frothiest housing markets are flashing a warning that looks a little bit alarmingly like 2008. We'll have all the details next. This is Bloomberg. Welcome back to the European Market Open, 8:38 in London, so 40 minutes or so into our trading session. And European equity markets paring losses, and in fact, US futures have really pared back on their losses and are now very much in the green for NASDAQ futures, at least, up by around 1/8%. Dow futures and E-mini futures flat to positive. Now, global real estate prices are flashing the kind of bubble warnings we haven't seen since the run-up to the 2008 financial crisis. That is according to some analysis by our economics team. And joining us with the details, our Chief Asia Economics Correspondent, Enda Curran. Enda, what is raising the alarm then? Where are we seeing these alarm bells sounding?
Well, indeed, Anna, it's like you mentioned, our colleagues at Bloomberg Economics have run the numbers, and they're seeing really this cocktail of factors: low interest rates, you've got trillions of dollars worth of government spending out there, trillions of dollars worth of household savings, a shortage of supply, and then of course you have this new work from home phenomenon, all adding up to this big house price spike right around the world's biggest, at least in the rich world. If this analysis is of the OECD countries. And what our colleagues have done is, when you look at some ratios, including real house price growth or house price to income ratios, house price to rent ratios, for example, they're showing a big surge now. As you mentioned, these house prices are back to that kind of warning level where we were back around that 2008 time when we had the global financial crisis, where a big crash in house prices was such a central part of it. So there's certainly warning signs flashing again.
Yeah, it's interesting to think about housing as a global asset because, of course, there are so many local conditions, local supply and demand dynamics, local regulations and tax effects that you need to take into account. I was talking to Simon French at Panmure, who mentioned how, because of the amount of time we're spending at home, and this has been a global phenomenon and not in office spaces, the sort of utility value that everyone attaches to housing has increased. And so he puts some of this down to that. So which of the geographies that we see as most affected?
You're absolutely right, Anna. Every national economy has their own story to tell. When you look at this particular league table that our economists have pulled together, those topping the list include the likes of New Zealand and Canada and Sweden. The US and UK aren't far behind. Of course, a lot of these economies were seeing pretty hefty house price momentum heading into the crisis anyway. And all this crisis has done is accelerate that. But like you mentioned, we now have these kind of idiosyncratic factors around its work from home phenomenon. How long does that last? Does it stick? And I think several developed economies have also seen this shift from cities to regional economies. We ourselves have reported on how regional house price growth has also spiked as people move away from the cities. So there's certainly something to be said for what's going on in terms of the pandemic specific effect. And of course, all of that stimulus flowing through is still having an impact. We are seeing some policy shift though. New Zealand, for example, is already trying to get a move on in terms of trying to cool down house prices there. And some other central banks, including Canada, which is on top of this list, near the top of this list, is also talking about a gradual exit from its own emergency crisis settings as well.
So when you start to see these warnings flashing 2008 style, Enda, you ask yourself whether we're going to see any crash. And I suppose that depends on whether any of the conditions supporting the housing market are about to change.
Yeah, exactly. And again, right here, right now, you have to say, look, interest rates are low everywhere. Economies are improving, employment levels are improving, you've got macroprudential measures in place, banks are in better order, or at least lending oversight with all of the regulations since the last crisis is now in place. So, you know, there are conditions there to say this is very different from what went on back in the 2000s. But I suppose the big question becomes, what happens when interest rates start to increase? And again, I mentioned earlier, we're seeing this shift now. Canada has signaled a way out of this. South Korea is being forecast by some economists to raise interest rates over the coming year or so. New Zealand could be in that basket. You've had, of course, this shift from the Fed last week. And to be very clear, we're still a long way from what you might call outright, tightening of monetary conditions globally. But it's happening, and we are moving away from these crisis settings. And a big test will become what happens when interest rates start going up everywhere. What kind of pressure will it put on borrowers? And like you mentioned, always local factors. Some markets are very much fixed mortgages, for example. Others are variable. So there's a lot at play. But nonetheless, it's going to be a test. And I don't think anybody can say for sure how this kind of burst of lending and burst of mortgage growth will play out as we do exit these crisis settings over the months and years ahead.
Thanks very much, Enza. Good to speak to you. Bloomberg's chief Asia economics correspondent, Enza Curran, with the global housing narrative right now. Sticking with things connected with Hong Kong, just seeing a red headline across the Bloomberg that says that Jimmy Lai's Apple Daily will halt operations after the Hong Kong arrests. Clearly, Jimmy Lai, an entrepreneur, an activist, a key player in the democracy movement in Hong Kong, founder of Next Digital and the Apple Daily newspaper, after all of his activity with regards to democracy got him into trouble with Chinese authorities. It seems as if we're seeing reports coming out of Hong Kong with regards to Apple Daily and the fact that it will, according to these reports, be halting its operations in Hong Kong. So interesting to watch as that develops. Let's get a Bloomberg Business Flash. Laura Wright has that.
Thanks, Anna. A blank check fund backed by billionaire Bill Ackman is buying 10% of Universal Music from Vivendi for about $4 billion. Ackman's SPAC Pershing Square Tontine Holdings says the transaction values the home of Taylor Swift and Billie Eilish at $42 billion, including debt. Morrison shares have surged above the value of CD&R's £5.5 billion bid, indicating the private equity firm may have to pay significantly more or fend off rival offers. Under UK takeover rules, CD&R has 28 days to make a firm offer or walk away from its attempt to buy Britain's fourth largest grocer. That's the Bloomberg Business Flash. Anna.
Well, thank you. Laura Wright here in London with your Business Flash. Now, the Biden administration has rejected Venezuelan President Nicolas Maduro's call for relief from U.S. sanctions. Responding to Maduro's comments to Bloomberg TV, a U.S. State Department spokesman said the Venezuelan leader needs to do more towards restoring democracy in the country. Maduro said he wants to work with the Biden administration on lifting sanctions and normalizing ties. He spoke exclusively to Bloomberg's Eric Shaska.
We always have to remember, Eric, that we faced 4 years of the Trump administration, which were 4 years of direct aggression, of cruel sanctions, very cruel, and of damage to the Venezuelan economy and society. The politics that Donald Trump installed and left as legacy against Venezuela are extremist politics, irrational, right? That caused a complete rupture between the United States and Venezuela. President Joe Biden has arrived, making a proposal to the world. His first speech on January 20th, he said that we don't have to demonize anybody in politics. I would say to President Joe Biden to stop from the White House, from the Department of State, the demonization of Venezuela, the demonization of the Bolivarian Revolution, the demonization of President Nicolas Maduro, and that hopefully we can find paths of reconciliation, of respect, paths of mutual benefit, and paths that allow us to normalize relations between the United States and Venezuela.
¿Ha visto señales ya? Have you seen any signals that suggest Joe Biden has a different posture, especially as it concerns the Venezuela question?
Do you want me to be sincere? Very sincere? There hasn't been a single positive sign. None. It's 5 months where, okay, they're settling into power. The only different thing that might be heard from some spokespeople of the White House and of the Department of State is that they agree with the political dialogue between Venezuelans, without intervention, to look for democratic political changes in the country. That's the only thing. They must abandon the demonization that they make of Venezuela, of our revolution, democratic, constitutional, Pacific, and of President Nicolas Maduro, to create real foundations, objective, credible, verifiable, of a process of negotiation to regularize the relations between the two countries, in terms of win-win, which is what we aspire to since a long time ago.
A win-win is possible, in your opinion?
Absolutely. We've already shown that. Of course it's possible to win-win. They know it in the financial sector, the bondholders, with whom we had an impeccable relationship, and they know it's possible to invest in Venezuela and win-win, as long as this whole persecution and the sanctions aren't there. The oil sector knows it, who has invested in Venezuela, and who still maintains investments in Venezuela, that we can advance much more. The cultural sector knows it. The social sector. The political sectors know it.
That was Venezuela's President Nicolas Maduro speaking exclusively to my colleague Eric Schatzker here at Bloomberg TV. Some lifelines just coming through to us from Hong Kong. The CEO of Hong Kong, Carrie Lam, still giving a news briefing over the last 40 minutes or so. And in it, she's been mentioning various continuation or removal of restrictions. And we've now got some headlines around travel. Hong Kong halves the quarantine for most residents returning from abroad. And Hong Kong also cutting the travel quarantine for vaccinated non-residents. So a few more details coming through on the amount of quarantine required in Hong Kong and how they will make those changes. Also talking about maintaining public gathering limits to 4. Coming up on this program then, unwinding the reflation trade. We're back to the markets conversation. We discussed the market moves we've seen since the Fed's hawkish pivot. That's next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open at 52 minutes into our European trading day. And what a turnaround after a very negative start. Continued questioning of those reflation trades around banks, around mining stocks. We seem to be taking our lead from US futures a little bit. And US futures paired earlier losses, now turning positive, certainly to a larger degree on NASDAQ futures, which are now up by 0.5%. And so that is helping the European equity markets get off those earlier lows. But what started this, of course, was all in the bond markets and a continued flattening of the US Treasury curve. Let's talk to Ven Ram, Bloomberg's MLive macro strategist, about some of that. Ven, very good morning to you. So the flattening of the curve that we've seen in the US Treasury market, it seems to be spreading into other assets, or at least impacting other assets, and spreading into other gilt curves in the UK or other fixed income curves elsewhere. How far through this are we, do you think, Ven? Is this the start of something, or are we done?
Well, it seems to be changing a bit of change in complexion, if you ask me, Anna. We saw the flattening, of course, in the curve last week. Now that's morphed into something like a bit more of a wider risk aversion. And that's because stocks have started feeling the jitters. Obviously, U.S. stocks plummeted on Friday. And even so, the U.S. stocks, to me, are looking frothy because they're overvalued by so many measures: market cap to GDP, PE ratios, price to book, price to free cash flow, despite the sell-off. So that may be that signals that there may be more pain for stocks to come, given that the hawkish Fed dot plot implies that stocks will now have to be discounted at a higher rate of interest. That in turn implies a bid for duration in the short run.
Right, and that was all supposed to be negative for tech stocks, wasn't it? In particular, ones that don't make all that much profit. That was what we saw earlier on this year when we were fearful of higher interest rates in the United States. Investors were getting out of tech stocks because, relatively speaking, they became less attractive. And yet now we see things turning around in the US and the Nasdaq catching a bid. And the Nasdaq and tech stocks seem to have been quite resilient to all of this jitters in fixed income markets. How do we think about that?
Well, I think that they will kind of resist some sell-off because there are some very attractive stocks in there, no question about it. And much of their heightened valuations are linked to their growth prospects. And the U.S. economy is expected to grow a whole lot, more than 6.5% this year. So they may resist the selling impulse, but not for too long, because you can't sustain horrendously high PE ratios for too long. So it's a game of who blinks first, and I think that will happen sooner rather than later.
And in terms of other assets that you keep in focus, obviously the dollar very much at the heart of this. But it was interesting to see the dollar react quite decisively to what the Fed did. It took a few days, but it gained, and it's hung on to those gains.
Well, I mean, absolutely. The dollar hasn't had it this good since the markets tumultuous last year. While the current risk aversion is supporting the dollar today, its longer-term trajectory will depend on the path of real rates, and which is why the dollar rebounded big time last week, because 5-year real rates shot up like a bullet. And if 5-year real rates continue to rise as they did sharply last week, then the dollar will no doubt strengthen. Indeed, it feels like we're in a heads I win, tails you lose kind of scenario for the dollar. If real rates decline and there is risk aversion, the dollar will be big because there is risk aversion. If the risk aversion ebbs out, on the other hand, and real rates climb, the dollar will still be very well placed. So it's definitely a win-win situation for the dollar at the moment.
That's interesting. Even those who, and other voices talk about the sort of more fundamental factors that weigh on the dollar, but maybe they don't get to cut through. Ben, thanks very much. Ben Rahm, Bloomberg's Markets Live macro strategist. Thank you very much for giving us your time today. So European equity markets spent the last hour then clawing their way back to the flat line. We are pretty flat for European stocks right now. US futures point higher. Surveillance early edition is up next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
We have proven now over the course of the past few years that we can reimpose sanctions in a devastating way, and the Iranians understand that.
Even while we're making incredible progress, it remains a serious and deadly threat. And the data is clear.
If we were able to do it for COVID, why not for cancer? Why not for Alzheimer's? Why not for many other diseases?
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Monday, the 21st of June. Happy summer solstice as well. I'm Francine Lacqua in London, and here's what's coming up on today's program. Investors sour on the reflation trade as a 30-year Treasury yield falls below 2%. How much flatter will the curve get? Nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee that the U.S. won't quit the accord again. And Germany and the U.S. warn against rising cases of the Delta variant of COVID-19. Joe Biden urges unvaccinated Americans to get a shot. So let's get straight to our top market story. And 30-year Treasury yields have fallen below 2% for the first time since February. Now that's as traders unwind reflation trades in the wake of the Federal Reserve's hawkish pivot last week. In fact, the St. Louis Fed President James Bullard also added fuel to the debate on Friday, saying that inflation risks may necessitate a hike as soon as next year. I believe he speaks again today with Mr. Kaplan. So let's get the very latest on the markets with our Danny Berger. Danny, so nice to have you back in the office. What are you looking at in the market?
Yeah, I can't tell you how nice it is to be back and not be stuck quarantining in my tiny little flat. Well, what an exciting day to come back, Francine. Basically, as you were saying that we hit below 2%, guess what the 30-year yield does? It goes back up above 2%. So look, in the Asian session, we had some pretty strong buying of the long end of the curve and really throughout the curve, but that curve flattening, taking a bit of a breather. You can see that there are people still going in, buying 5-year yields, buying 10-year, but you have to go, like 6 decimal points back to actually see the move. But that doesn't mean that this trade is necessarily off. There definitely is this debate emerging of whether the Fed has now changed its reaction function. And if it has, if it's going to swat down inflation anytime it gets a whiff of it, why be scared of duration bets? And speaking of duration bets, I just want to show you quickly what's happening in the equity markets, because it went from this yield curve flattening to spilling out into other aspects of the market. So this is the close of the Japanese market. It ended down more than 3%, a very value-heavy index. So it makes sense that the underperformers in this context of long duration being back in vogue, to see Europe down, to see Japan down, both value-heavy indexes, and to see NASDAQ outperforming. Again, this is where you want to be if inflation is going to be controlled in the long term. But S&P 500 futures doing well, okay. So it started as a very risk-off day. Now it's getting a little bit more nuanced, Francine.
Danny, thanks so much. Our Danny Berger there with the great inflation unwind. Well, joining us this morning is Philip Hildebrand. He's vice chair at BlackRock for many years. Of course, he was also central bank governor. So, Philip, you're one of the best when it comes to figuring out what central banks can and can't do in terms of communication, how the market interpret it. So thank you so much on a day like today, especially for being with us. Philip, when you look at some of the things that we should be looking at, which is the unwinding of the reflation trade, is this just buying time for investors to understand fundamentally what kind of economy we're left with?
Good morning, first of all, Francine. It's great to see you back in the office. I hope I can join you sometime soon. Well, I think you get to the point here. Markets are still trying to get used to, in a sense, and find their way around the new framework that the Federal Reserve has adopted now for some time. And I think that's what's going on here. If you look at the new inflation projections in the framework, basically, they will tell you that they're just about aligned with this idea of overshooting inflation for a couple of years in order to make up of past undershoots. So I think it's taken, unfortunately, some time for the market to really come around and, in a sense, embrace the new framework. And I think we're still testing the waters on that. My guess is this will settle down as we move forward and as the market understands that the Fed has a new framework and that, in fact, the new inflation projections are very much aligned with this notion of overshooting to make up for past undershooting of inflation.
So if you look at this new framework that you eloquently actually lay out, what does it mean for the rest of the world? Does it change the way that we should frame and talk about the ECB and the Bank of England and the Bank of Japan?
Well, as you know, one of the great features of this crisis has been, in a sense, something we've called a policy revolution, which in many ways is a blurring of the boundaries between fiscal and monetary policy. So far, the Fed is the only central bank that has embraced a new framework. We're about to see in a couple of months the new one by the ECB. That'll be very important to see whether another major central bank joins this overshooting idea. My guess is that's what we're going to see. We're going to see a trend towards saying we have undershot inflation for many years. Now we're accepting some overshooting in order to make up for that over time. And then the question will become how much overshooting and for how long. And this is exactly where markets are, remain quite volatile around this question, as you can see in the last few days. So I think it's a kind of getting into testing the waters into a new framework, which one way or another will be embraced by other central banks as well in the world. But the Fed was definitely first in officially, formally changing its framework last fall.
What does Philip Hildebrand, a policy mistake from the Fed today actually look like?
Well, a policy mistake, I guess, would be if they don't manage to impose credibility of the framework. And you saw a little bit of a flavor of that. I don't want to read too much into the 24-hour kind of price or news cycle, but you saw a flavor of that. In other words, if they can convince the markets that they're serious about overshooting inflation for some time in order to align themselves with the new framework. And of course, in that context, the fact that inflation expectations have come back again so quickly after the meeting is not great news. But again, I wouldn't read too much into this. We're too focused on the day-by-day news cycle and price action. The key here is the current inflation forecast of the Federal Reserve basically implies is the minimum you would need in order to align yourself with this new principle, the core principle of the new framework, namely that this make-up strategy that you're going to have a couple of years of higher inflation in order to make up for past undershooting.
What does it mean so the markets at some point will settle, I guess, when they figure this out. What's the next catalyst for the markets?
I think just a little bit of time. I'm still struck by lots of discussions and, frankly, diverging views around what the Fed is really trying to do. And this, by the way, I think is also an important lesson for the ECB as they go into the final stage of this deliberation of the new framework, which I suppose will be announced sometime in September, to really be very clear as to what the new framework is. The framework the Fed has adopted is presumably by design, fairly loose. We have felt it lacks some guardrails around precisely the timing of how long you intend to overshoot. And I think it's these uncertainties that then give rise to different market views, and that gives rise to price volatility. Again, I think, a couple more press conferences. Speeches are not always helpful because, of course, anybody on the FOMC can speak. And as we saw the other day, that can confuse the message. So I would focus on the official communication and see how they intend to implement, in a sense, live this new framework over time.
Philip, is there anything that you worry about how we view the recovery? I mean, one thing that keeps on striking me almost day in, day out is actually the UK, one of the most vaccinated countries in the world. And then we talk about, the resurgent possible fourth wave of COVID-19. Is this something that actually, it's very difficult to forecast, so it's very difficult for economists to actually put into their forecasts. Is that where we could have a mismatch, or is there something else that you worry about?
I think the most important thing is this is not a recovery, it's a restart. And it's very important to keep that in mind. It's a completely different dynamic than, what we would have had after the financial crisis or any other crisis where you have a kind of normal business cycle recovery. This is like a beach resort that opens on day one and the beaches are full. We're going to see huge GDP numbers, and the US demand is going to be enormous. Europe will lag not far behind. So I think we need to expect a lot of volatility around the data points because this is a restart, not a recovery. It's completely different. And we have, because it's so different and so sudden, we have a lot of bottlenecks in the supply chain. So take those two things together, we're going to have a lot of volatility. And I think the key is to look through that. What I'm worried about most, I suppose, is still COVID, right? This is all based on getting out of the pandemic. We have a clear path to get out of it, and that's through vaccination. I worry that 85% of all vaccines that have been administered have been done in the rich world. So that's clearly not only a moral, but also a major economic problem that the world faces. And then we just need to make sure that this vaccination strategy persists and can complete so we can see continuation of this restart, and then ultimately growth will settle into whatever the new potential will be after the crisis. So I think the key risk factor to watch continues to be vaccinations, the vaccination strategy, the global aspect of that, and the pandemic generally. In other words, how we can ensure that we don't have something that kind of puts us back into COVID mode again.
Philip, thanks so much. Philip Hildebrand there from BlackRock stays with us, and we'll talk a lot more about coming back to work. Because coming up, getting back to the office, BlackRock says staff can start going back into work from next month, only if they're vaccinated. So more on the return to work next with Philip Hildebrand. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
As more people get vaccinated, we keep bringing more back. We got a lot of work to get those back. But the view is after Labor Day, our view is all the vaccinated teammates will be back and will be able to operate fairly normally, and we'll then start to make provisions for the other teammates as we move through the fall.
Well, Bank of America is not the only big money manager putting conditions on its staff returning to the office. BlackRock announced on Friday that only fully vaccinated workers would be able to return to work starting in July. Now, all employees will be also expected to report their vaccination status by June the 30th. This comes as the U.S. hits a milestone of delivering 300 million vaccines. Now, even so, it's at risk of missing its vaccine target, getting 70% of all adults receive a single shot by July the 4th. The president urged unvaccinated Americans to get inoculated, warning about the highly transmissible Delta variant.
Even while we're making incredible progress, it remains a serious and deadly threat. And the data is clear. If you are unvaccinated, you're at risk of getting seriously ill or dying or spreading it.
Well, still with us is Philip Hildebrand from BlackRock. Philip Hildebrand, thank you so much for staying with us. I mean, there's quite a lot of debates going on in big corporations on how you get staff back to work, whether you fully open, whether you do distancing, whether it's flexible working. Like, you know, what are some of the discussions that you had to come to the conclusion that BlackRock has?
Well, first of all, I'd say safety, right, is always the paramount concern. You want to make sure that your employees are safe and feel safe. That's a very important piece of it. It's also true, and I believe this very strongly, that a great company is made up of two things: a great business model and a great culture. And it's very hard to persist on the culture front if you work remotely. We believe strongly that informally interacting, being together as a community is a very big part of the culture. And, you know, we haven't seen our colleagues in a long, long time. I'm looking forward to seeing my colleagues in the executive committee for the first time later this summer. So the cultural piece is extremely important. And we want to make sure that everybody comes back together in a safe environment so that they can feel safe. So vaccination, getting vaccinated is really something you do for yourself, of course, for your family, but you also do it as part of a culture, as part of a company to help protect others, to help others feel safe. And that's very much the way we look at things.
And Philip, how do you see, for example, executive travel or just like business travel? Because I hear both sides of the coin. People saying actually we'll go back to normal or close to normal in the next couple of years. And then people saying, you know, 30% of my meetings I could do virtually, and now it's proven that it doesn't actually impact so much. So how do you see it changing, I guess, and developing as a legacy of COVID-19?
Probably a bit of both. I mean, we are human beings. I've been around long enough to know that humans are what they are. They like to move, they like to go places, and they like to socially interact. And that's a very important part of life, and we should embrace that. So I would certainly expect a lot of it to come back, particularly with regard to clients, new clients. There's nothing that makes up for the interpersonal exchange. On the other hand, will I go to Singapore or Hong Kong for one meeting and get on a plane and come back the next day, as I would have often done in the past? Probably not. So I think a hybrid version, particularly with people that you know well, right? I think that's the key difference. Communities, people, clients that you know very well, where you spend a lot of time in person, it makes perfect sense to continue some of the...
Hello traders again. As you can see, we closed position on Japanese yen at 110.28. Just right here. As you, we have 1,000 pounds in profit. We was holding it for over the weekend. So all of you guys, you already collected profit. Well done. Let's move on to another pair that will give us nice profit, okay? I'll speak to you later. For other people who would like to find out how we trade, why we was waiting for exactly this price to stop and sell our position, you need to get the strategy. It's available on company.co.uk. And when you will get it, you will find out all the information. By the way, after tomorrow on Wednesday, I'm going to run another series of webinars. This time I'm going to speak about arbitrage, how we trade and how we use arbitrage when we trade Forex. So in order to join our webinar, you need to go to company.co.uk and you need to get the seat. You need to buy the seat for this webinar. I'll speak to you later, guys. Stay safe.
The anchor of inflation expectations, and that will determine everything else. So I think as long as we can get to that place, I'm not particularly worried about liquidity at the moment, but we should certainly watch it. There will be volatility around it as a result.
You always make us smarter on banks and how we should be thinking, especially about the banking sector in Europe. We know, of course, that the ECB will meet to decide whether they actually lift their cap on dividends next week. Is that important, just for investor confidence, that that cap is actually lifted now?
I'm not sure, to be honest. The good news is, partly because of what we've done after the financial crisis, banks have gone through this huge problem in the history of economics without any major problems. In fact, when I talk to CEOs right now, I notice that all of them are telling me that they're actually revising downward their provisioning month by month. And so things are turning out even better than they would have expected. And so we're coming out of this pandemic, in a sense, with robust balance sheets. And that's very important also with regard to your previous question on liquidity. We have a strong banking system coming out of one of the worst crises we've gone through. So that's very good news. Whether they lift this cap or not, frankly, the key is the responsibility of the banks themselves to do the right thing, particularly as we enter this environment of a huge restart, which we know won't last forever. This is not a recovery, it's a restart. And so I think much more important than what we do on the formal regulatory side is how banks behave themselves in terms of going through these next couple of months.
Philip, thank you so much for joining us. Philip Hildebrand there, the Vice Chair at BlackRock. Now we'll have plenty more, of course, on the markets throughout the day. Also coming up, talks to revive the Iranian nuclear deal drag on as Iran elects hardline cleric Ibrahim Raisi as president. And then a little bit later, we'll also talk about Bitcoin declining amid a significant fall in the hash rate. Now, what's the hash rate, you ask? All of that and much more later with our Eddie van der Walt. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Emmanuel Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. Now, the U.S. has rejected Venezuela's call for relief from sanctions, saying more needs to be done towards restoring democracy. President Nicolas Maduro reached out on the issue in an exclusive interview with Bloomberg.
I would say to President Joe Biden to stop, from the White House, from the Department of State, the demonization of Venezuela, the demonization of the Bolivarian Revolution, the demonization of President Nicolas Maduro, and that hopefully we can find paths of reconciliation, of respect, paths of mutual benefit, and paths that allow us to normalize relations between the United States and Venezuela.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The curtain will rise rise again.
Broadway's returning June.
If you bought tickets,
Is busted out.
you've got more time here. If you want.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Investors sour on the reflation trade as a 30-year Treasury yield falls below 2%. How much flatter will the curve get? Nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee that the U.S. won't quit the accord again. And Germany and the U.S. warn against rising cases of the Delta variant of COVID-19. Joe Biden urges unvaccinated Americans to get a shot. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Monday, the 21st of June. So talks to revive the Iranian nuclear accord have ended without agreement. Diplomats adjourned a 6th round of meetings with major gaps remaining on the accord. Now, this comes one day after the hardline cleric Ibrahim Raisi was declared the winner of Iran's presidential election. Raisi's win could further complicate diplomatic efforts. Now, the U.S. National Security Advisor Jake Sullivan told Fox News that preventing Iran from obtaining nuclear weapons remains a priority.
Well, I think what we need to do in the United States is keep our eye on the ball. And that is our paramount priority right now, is to prevent Iran from getting a nuclear weapon. We believe that diplomacy is the best way to achieve that rather than military conflict. And so we're going to negotiate in a clear-eyed, firm way with the Iranians to see if we can arrive at an outcome that puts their nuclear program in a box.
Well, joining us now is our Iran reporter, Golnar Montavali, who I'm delighted is here in the studio with me. So, Golnar, thank you so much for joining us. I know you've been covering this right from the start. You've covered Iran also for decades. So what do we know about this new hardline president and actually what it means for the prospects of this nuclear deal?
Well, he's the head of the judiciary. He's an ultra-conservative. He comes from a very religious background. He's a hardliner. He is naturally very suspicious of engagement with the West, particularly the US. He is part of the hardline camp of Iranian politicians who are always very highly critical of America and don't want to see, frankly, softer relations between Iran and the US. So there's a huge question mark right now about what that means for Iran's broader foreign policy. But immediately, when it comes to the nuclear deal and the nuclear talks, there's a sense, I think, that they're going to be ring-fenced because the policy to continue those talks and to get the deal revived, particularly before June 24th. That's an important date, Francine, because that's when Iran's technical agreement with the UN nuclear inspectors expires, and there's talk of that being renewed so that there's more time for diplomats to get this deal back and running. But that policy to revive the nuclear deal, that's with Ayatollah Khamenei, the supreme leader, and the Supreme National Security Council in Tehran. And there are already signs from Raisi that he wants to preserve the accord. He said so during his campaign. He had a meeting with Foreign Minister Zarif today in Tehran. And there are all sorts of signs coming from Tehran that there is no intention there to kind of throw any spanners in the works in terms of Raisi's arrival in government as president.
So, Golnar, so I was reading up, and actually in 2019, the Trump administration also put sanctions on him personally.
Yeah.
So do those need to be removed for anything to happen?
Indeed, Francine. There's another question mark over that. So, as you said, in 2019, as part of the maximum pressure strategy, the Trump administration included Raisi, explicitly naming him in new OFAC designations. Those are sanctions effectively on Raisi. And Iran has said that the entire onset of new sanctions under the Trump administration, those need to go for the nuclear accord to be revived. So they want all these sanctions associated with Donald Trump, not just those that came as a result of the US quitting the JCPOA, but all of the sanctions that came afterwards as well need to go. And that includes designations on the new president-elect of Iran, Ibrahim Raisi. And I don't think that, there is a question mark now over whether the US will reconsider removing those sanctions or not, but we have to wait and see.
Does there need to be an intermediary between the U.S. and Iran? Is there anyone that actually President, Raisi is close to that could play that role?
That's another interesting question. We don't know what Raisi's foreign policy team is going to look like. I mean, the likelihood is that obviously they're going to be hardliners. They are probably not going to be people like Zarif, Mohammad Javad Zarif, who very famously has very eloquent English, who likes to use these kind of flawless sort of idioms and flourishes of diplomatic language. That's unusual in Iran. That is unusual for the Islamic Republic. And we may see a team that looks more similar to what we had under Mahmoud Ahmadinejad, who was the previous hardline president before Rouhani. We may see elements of his team return. We know that Saeed Jalili, the former nuclear negotiator under Ahmadinejad, who was also running in the presidential race and withdrew to throw his weight behind Raisi, will probably be rewarded with some kind of senior role, whether that's first vice president, we don't know. But there are big question marks over this. And I think that's why the nuclear deal issue is going to be ring-fenced for that reason, because Rouhani's team, if you remember, came at the same time as Barack Obama's team did in Washington. There was this kind of alignment of different factors in 2013 that allowed the kind of ecosystem to kind of build around the nuclear deal in the first place, which was then agreed in 2015. We don't have that this time. So I think Khamenei knows that he needs to ring-fence the talks and all the action around the nuclear deal in general.
Golnar, thank you so much. I could talk to Golnar for another 2 hours, so we'll get you back on. Golnar Montevalli, there, our Iran reporter. Now, smaller companies in Britain's FTSE All-Share Index are lagging behind their larger peers when it comes to having diverse representation on their boards. That's according to a report by Women on Boards UK. And my next guest says that previous reports looking at FTSE 350 firms only paint an incomplete picture and mask the true picture of little diversity progress. Well, joining us now is Fiona Haythorne, Chief Executive Officer at Women on Boards. Fiona, thank you so much for joining us on this very important topic. So what have you found, and how do you explain this little representation?
Well, firstly, we found that only half are meeting the 33% target of women on boards. And more worrying, 54%, that's more than half, have all male executive teams or all male leaders at the top. And we find that completely unacceptable. And you will remember that the Hampton-Alexander, our government, has had a lens on the FTSE 350 and argues that it's almost job done. We've made a lot of progress, and we have. But at the FTSE 350 level, only 6% are all male leadership teams. So compare that with the FTSE All-Share, those smaller companies outside the FTSE 350, and there's a lot of work still needed to be done. We also looked at the gender pay gap reporting for the first time ever for all of those companies, and that was a bit of a shocker too.
So, Fiona, does the pandemic has it made things worse?
Well, the pandemic has clearly been very difficult for women in general because of the caring responsibilities that society seems to put on their shoulders. But I think longer term, the pandemic has showed us that flexible working does work for all, men as well as women. I think what we've got to be very careful as companies move forward in this new hybrid world in the way we're working is that women in particular do still go back to the office from time to time and do actively manage their careers. I don't mean being present all the time, but being very, very clear what you contribute, because those networks and relationships matter. So I think we've got to be very careful going forward. And what we do know, looking at the FTSE All-Share, is the gender pay gap is around 20% for all of those 600 companies against the average of around 14%. But worse, the bonus gap is 40% against the average of 20%. So what we really need is the government to still put a lens on all of those companies, because what gets measured gets managed, and what gets managed gets done. And I will talk to you shortly about leadership training and treating it like a change program. Yeah. Stop fixing the minority.
But Fiona, does it have to go through compensation, incentives, quotas, or what is the right approach?
Well, I mean, we've had a comply and explain approach, and we've put a target of 33%. But that's fine. But targets only work if you measure, manage, and monitor. And what this research has shown is outside the FTSE 350, nobody's measuring, nobody's monitoring. And I think we need to keep that lens on. Now, as we can see in France and Germany at the moment, they're looking at quotas for the executive teams to come in. I hope we don't need to do that. I'm sure we don't need to do that, but we do need the government to continue putting a lens, not just on the FTSE 350, but all of these companies, because somebody's got to measure and monitor, otherwise nothing happens. 54% of those companies outside the FTSE 350 that haven't been measured, haven't been monitored, still have all male executive teams. So a lot needs to be done in terms of leadership and conscious inclusion. I don't mean unconscious bias training, in how we make sure that our economy remains strong and innovative, and uses all the talent in the UK. And we know from all the research from McKinsey and everyone else that diverse teams perform better, but only if you can manage them effectively.
So, Fiona, where exactly is the sticking point? Is it at recruitment level? Is it that you don't find, you know, the kind of the right people in the C-suite to then be promoted?
I think, you know, it's systemic within our society. Our society has a view of what women can and can't do, and that needs to be tackled. And that's throughout our education system. And we know from between the ages of 4 and 6, young girls in particular have a different perception of what they can and can't do. And that's still the case today. So we can't blame the companies for everything. But what we can ask companies to do is to set targets so they actively manage what's happening in departments and divisions, to make sure that if you recruit the best graduates, then they have an equal chance of being promoted, and you can measure and monitor that. So that's where a lot of the progress has to be done. You need to understand what's our intake, how are we keeping them, and what the issues are, and the issues that individuals face, whether it's somebody who's disabled, whether it's somebody who's black or an ethnic minority. And that's the other thing that we also looked at in the, I must mention this, in the FTSE All Share outside the top 350, we found that only 3% of board directors were directors of colour, and Fiona, only 16% have met the Parker Review target. Not good enough.
Fiona, thank you so much. Fiona Hathorn, absolutely not good enough, chief executive there of Women on Boards. Now, London turns its Olympic Stadium into a pop-up vaccination centre. Britain's government pushes for its entire adult population to be vaccinated, but cases of the Delta variant are still surging. How concerned should other countries be about the UK's spike in infections? We'll discuss that with Sam Fazeli up next. This is Bloomberg.
technology landscape has gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Biden administration has rejected a call from Nicolás Maduro for relief from U.S. sanctions. Responding to Maduro's comments to Bloomberg TV, a State Department spokesman said the Venezuelan leader needs to do more towards restoring democracy and engage with the opposition. The U.S. doesn't accept Maduro as Venezuela's legitimate president and instead recognizes Juan Guaido, the leader of the National Assembly, as the interim president. While Maduro said the sanctions are cruel and immoral, he spoke exclusively to Bloomberg's Eric Schatzker.
I believe that the sanctions are immoral. That's the first thing. They are cruel, very cruel for a country. And I think that at a round table of conversation, even if it's private, the United States of America, the Biden administration, should accept it as such, should see it as such. And the sanctions are transformed. As the Human Rights Organization says, the special reporter that came to Venezuela for the matter of the sanctions are transformed into a great violation of the human rights of the Venezuelan men and women. Furthermore, not only is it a cruel mechanism that causes suffering to the people, but it's also a failed mechanism. Failed. Because all the sanctions, in an extremist and irrational manner, were applied by the Trump government against Venezuela for a change of regime. And they didn't achieve it. Nor are they going to achieve it. So the sanctions should be recognized as illegal, irrational, extremist, cruel, and they should be lifted.
En su opinión, señor presidente, pero todavía es la política.
In your opinion, Mr. President, but it's still U.S. policy. And it seems to me the U.S. won't change its policy without a change in positions.
Entonces es un juego cerrado, Eric.
Then it's a closed game, Eric, because we have our principles, our Constitution. We have the right to life, to economic freedom, to commercial freedom. Venezuela and the whole world has the right to commercial freedom. There can't be one country that, because of the control of the currency and of the banking system, imposes to the rest of the countries of the world what should happen in their country at a political level, who should govern or who shouldn't govern. If that was established, Eric, it would simply be the end of the United Nations system, the end of the international law.
Venezuelan President Nicolás Maduro there speaking to Bloomberg's Eric Schatzker. Eric also spoke with Maduro's opposition, Juan Guaido, who is recognized as the interim president of Venezuela after an election that the U.S. and many others said was rigged. Guaido said the pressure of sanctions has increased the possibility of a deal with Maduro.
Maduro siempre quiere negociar.
As I said in the beginning, Maduro always wants to negotiate for the same reason. To ease the pressure, earn time, and try to confuse the democratic alternative. You talk about different groups. Today, the advantage is that together we have set the possibility of an agreement that will be negotiated, facilitated dialogue, the support of the international community.
So we'll have plenty more, of course, on Venezuela throughout the day. Now, a major push to offer COVID-19 jabs to every adult in England is underway, with queues forming outside pop-up vaccination centres, including at West Ham's London Stadium, where the 2012 Olympic Games took place. But the Delta variant of the virus has made infections spike in the UK once more, and this has prevented the government going ahead with its planned relaxation of overseas travel restrictions. Well, joining us now is Sam Fazeli. He's the Director of Research at Bloomberg Intelligence. Sam, first of all, there's quite a lot going on in the UK. It's one of the most vaccinated countries in the world, and yet there are 10,000 or more cases a day. What exactly do you see in the UK that could have done better, or does it just show the limits of vaccinations?
Francine, no, I think the UK has done a pretty good job. We still have to wonder whether that one-dose strategy for like 10 days was absolutely the right way to go, but it certainly helped bring down the mortality rate. But I can tell you that when you look at my favorite data source, which is the Zoe COVID-19 symptom study, you've got about a six-fold increase in the positivity rate of people who've not been vaccinated in the past 4 weeks, compared to just a twofold increase in those who are fully vaccinated. So, and the difference between them is like tenfold. You have a very small 0.25% positivity rate in fully vaccinated people versus 2% positivity rate. Clearly, the vaccines are working. And therefore, what we saw yesterday with a massive push is absolutely the right thing to do.
Sam, so we see quite a lot of travel companies actually trying to put a lot of pressure on the government here to ease restrictions. Like, what do we know about that? Do you write off summer holidays for the Brits abroad?
Well, not if you're very happy to go to Cornwall and Devon and the Lake District and Scotland and Wales, but in terms of international travel, it's complicated by several issues. The UK can do what it wants, but if you've got people like countries like Italy that then introduce a 5-day quarantine, I'm not sure anybody would want to go there. And I would not be surprised if other countries, given that they're bringing their cases down so well, Germany and France particularly, would welcome people from an area where there is a rampant infection with the Delta variant with open arms. What happens with double vaccinated, fully vaccinated people is an interesting question. I'd love to hear the answer to that from the government.
Sam, thank you so much. Sam Fazeli there, Director of Research at Bloomberg Intelligence. Now, coming up, cryptos sink as China cracks down on Bitcoin miners. Up next, we'll drill down on this morning's market action. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Farrow. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, cryptocurrencies are taking another hit as China cracks down on Bitcoin miners. For the latest on what's moving the markets today, we're joined by Bloomberg MLive's Eddie van der Velde. Eddie and I also, off the record, are talking about him possibly getting a puppy, but away from puppies, actually boom market. Eddie, what are you looking at? It's the reflation trade not quite working out anymore.
Yeah, it's very difficult for cryptocurrencies at the moment. The China narrative is part of the story. And, you know, the relationship between Bitcoin and the miners are a complex one. If you see fewer miners, that doesn't mean that you see fewer Bitcoin being created. It just means that the difficulty of creating new coins comes down. So it's really complex. It's not like looking at a traditional mining model from that perspective. But at the same time, I think what we're seeing here is we're just seeing the pressure from regulation and from policymakers in general on cryptocurrencies just starting to bear out. Now, in the long term, I think greater regulations are positive for cryptocurrencies because we need to get them into the broader financial fold to get mass adoption. But for the time being, if you see China putting pressure and you see Basel putting pressure, then you're going to see crypto prices going lower.
Yeah. So what exactly is the hash rate?
So the hash rate is the difficulty or the amount of the amount of computing power that is dedicated to creating new Bitcoin. But if you will remember that Satoshi Nakamoto in the original white paper said there will only ever be 21 million Bitcoin, and the rate of production remains pretty much stable. So as you put more computers on solving these problems, what happens is the problem becomes more difficult or easier. So the rate of production of cryptocurrencies, of Bitcoin in particular, stays relatively stable as the amount of miners change.
Eddie, thanks so much. Bloomberg MLive's Eddie van der Velde there. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin, Kay Lines out of New York. We'll have a full roundup, of course, of the markets. We'll talk Iran. We'll talk cryptocurrency some more. We have you covered. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The bond market has its own brain. It's a very shrewd operator.
Overheating has been a major concern of mine. I'm glad to see that they have that recognition.
Are we at peak growth right now? Yes, probably.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, it's 10 a.m. here in London, 11 a.m. Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, June the 21st. Our top stories today. Investors sour on the reflation trade as the 30-year Treasury yield falls below 2%. How much flatter will the curve get? Nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee that the U.S. won't quit the accord again. And crypto crackdown, Bitcoin sliding amid a risk-off mood in markets and a clampdown in China. So definitely quite a lot going on in the markets. Kaylee, we heard from James Bullard. I think he's speaking today again with Robert Kaplan, and that will give us an indication of what markets do next.
Yeah, markets really paying attention to the Fed, Francine, and any indication that maybe they're not going to let inflation and the economy run quite as hot as we maybe previously thought. Just a recap of what we saw in the Asian session overnight, it was broadly negative. Most of the major benchmarks lower, including the Hang Seng, which was down about 1%. And your real underperformance came from the Nikkei in Japan, which fell 3.3%. Japanese equities, of course, quite cyclical. They may have been weighed down on quite a bit by the fact that we saw that reflation unwind happening here in the U.S. on Friday, and that followed through in the Asian session. Also, I would note in foreign exchange that Japanese yen is stronger against the dollar by about 0.25%. And then Bitcoin makes it on my Asia board today because, of course, the fear around the crackdown on mining in China is really weighing on the cryptocurrency. That hash rate is moving lower, and as a result, Bitcoin also moving lower. Right now, it's just shy of the $33,000 level. As for what the picture looks like here in the U.S., the older the future session grows, the more positive it becomes. Right now, S&P 500 futures up about 15 points. It is NASDAQ 100 futures, though, that are outperforming, so it does look like big tech may still be leading on the day. In the bond market, the 30-year Treasury yield fell below 2% earlier in the session. We are right now essentially unchanged at 2.02% or so. And actually, after 3 days of flattening, the curve is steepening back just a touch. The 530 spread now sitting right around 115 basis points, and keeping an eye on oil as well. That Iran nuclear deal still out of reach after the 6th round of talks in Vienna. Right now, WTI is trading just below $72 a barrel, Matt.
All right, we'll be watching, Kaylee, oil very closely, obviously. The situation in Iran is prompting many to question whether we go from a supply, too much supply, to a supply shortage. And this is going to definitely put an exclamation point after that question mark. Let's take a look at what's going on here in Europe. It is hot. Maybe that's a reason that you see red on the screen in a few places. Spain right now, France and the UK, little changed. It's a good day to work at home if you have AC, or come to the office if your office has AC, which is a huge if. in Europe. I also want to point out that the DAX is a big gainer. We have almost 2 winners for every loser here in Germany, so it's doing much better than the rest of the continent. The euro getting a little bit of a bounce, but it had come down substantially. So the ECB is doing its job well versus the Fed, but right now we see a little bit of a bounce in the currency, a little bit of a bounce in the pound as well as the dollar comes down. And then, you know, last week, Francine, someone on Twitter, a viewer on Twitter, was very angry, had enough of me making fun of the British and their obsession with supermarkets. Now, I pointed out, I do it in jest. I love the British. I lived in Britain and enjoyed my years there, and I love those supermarkets as well. William Morrison is up 32%. It could get taken over, but it's not the only supermarket gainer. You see big gains in Sainsbury's, Tesco's, and Waitrose as well. So watch, I forgot to mention Marks and Spencer's. Watch those British supermarkets today.
Yeah, I don't see you shopping at M&S. Maybe Morrison's. I think you're more of a Savile Row kind of shopper, Matt. Correct me if I'm wrong.
As I have previously mentioned, M&S is a good place to buy underwear. If you're just looking for your typical tighty-whities, your Y-fronts as you call them, M&S is a good place to get those.
The Myth of a Fashion with Matt Miller. This should be like a regular segment at 5 a.m. just so that if you're coming to the UK, if the rules change on how you travel, you know where to get your bits and pieces. Now, this is a look at what else is ahead this week. Of course, the Qatar Economic Forum kicks off today. That's at 8 p.m. Eastern Time. The first day speakers include Ray Dalio, Larry Summers, and the South African President, Cyril Ramaphosa. Tomorrow, New York City goes to the polls for the hotly contested mayoral election. We'll have special coverage across Bloomberg throughout the day. Also tomorrow, U.S. Secretary of State Anthony Blinken kicks off a trip to Europe. He'll start in Berlin by meeting Chancellor Angela Merkel. And then on Thursday, it's the key central bank event of the week. Of course, the Bank of England announces their latest policy decision. We look at the Bank of England on how they also see a possible fourth wave of COVID-19. In other news, another round of Iran nuclear talks have ended without agreement. This comes one day after hardline cleric Ibrahim Raisi was declared the winner of Iran's presidential election. Well, joining us now is Golnar Montevalli, Bloomberg's Iran reporter. Golnar, so what does this mean for the nuclear accord? And first of all, does the U.S. need to get rid of the sanctions against the president-elect for anything to happen?
Hi, Francine. Yeah, so with Ibrahim Raisi becoming president-elect, obviously there's a big question mark now over whether that's going to have any effect on the talks that are happening in Vienna over reviving the deal. The signs and the signals we have from Tehran so far are that he wants to preserve the accord. He said that during his election campaign, and there is a definite sense that the nuclear deal and foreign policy is being ring-fenced for now because Supreme Leader Ayatollah Ali Khamenei, who ultimately makes those decisions, has so far backed the talks to revive the deal. And there's no sense that there's going to be any major spanner in the works. But there's obviously a big question mark over these sanctions that you just mentioned. Raisi was directly sanctioned by the Trump administration in 2019. He's designated under those OFAC sanctions designations. And whether those are going to be lifted now, that question mark is going to be revived. I think there was a sense before his election that they were definitely going to be lifted by the Americans as part of that agreement to revive the deal. And now we're seeing kind of louder noises around his background, particularly on human rights. And that may raise some kind of flag and some question mark over whether the Americans will be willing to lift those sanctions.
What does this mean for oil exports? I know they've been able to get some out to China and some other countries, but how many barrels a day are they exporting, and how many barrels a day could they be exporting were we to make a deal?
Well, they obviously want to get back to pre-sanctions export levels. So we're looking about 2 million barrels a day. It's going to take time, obviously, for that to happen. They are pumping oil. They're still producing quite a significant amount of oil, again, though not in the levels that they were before sanctions. So that's another obvious big question mark. Because we don't know when this deal is going to be revived yet. Everyone is looking at kind of two different deadlines now. We're looking at June 24th, when this technical agreement that Iran has with the IAEA, the UN nuclear inspectors, expires. And then we have mid-August, which is when Hassan Rouhani, the moderate president who championed the nuclear deal, leaves office and Raisi takes over. But if we do get a deal before mid-August, if the deal is revived again, then Iran expects to be able to get back up to pre-sanctions levels of oil output within 3 months. So we're looking at an aim, I think, probably towards the end of the year, at the end of the last quarter of 2 million barrels a day, if the nuclear deal is indeed revived.
Right, a big if there. Bloomberg's Golnar Matavali, thank you so much. Turning back to the markets now, and investors are shrugging off last week's bearishness after the Fed's surprise hawkish turn, with U.S. futures climbing and longer end treasury yields turning higher. Here's Bloomberg's Danny Berger for more. And Danny, the curve steepening once again.
Yeah, it really is. Finally, a little bit of calm in the market. How long will it last? That's certainly a big question on everyone's mind. But coming into this week, this is the picture we had faced. We had seen the most severe flattening of the curve since 2011 last week. And as the Asia session unfolded, when I came in here at 3:30 a.m. London time, it's definitely within the meat of the day of the Asian trading session. Let me show you how the U.S. 30-year yield looked, because we continued to see investors flocking into it. You had this big dip, but as the European session opened up, as we moved away from that Asia heavy session, you did get some of this yield coming back up, and indeed yields moving higher now. And across the board, that's really what we're seeing. Some of the risk aversion taking its foot off the gas pedal. So if I can show you what a couple of different assets are doing, we are definitely still seeing some buying, for example, in the 10-year yield, but you are seeing stocks that are more cyclical in nature underperform. That doesn't mean that they're necessarily totally negative, but it still is a little bit of that flavor where things like the Stock 600 here in Europe are underperforming something like the NASDAQ 100. So still you get this sense that the reflationary trade is still not in vogue. However, we're not seeing as severe of a sell-off in a lot of these type of assets as we did at the end of last week.
All right, Danny, thanks very much. Danny Berger talking to us about the reflation, deflation. We'll check in just a moment with an investor whether or not that is going to pause now. Over in Hong Kong, though, Bloomberg has learned that Jimmy Lai's Apple Daily will suspend operations if its Hong Kong accounts stay frozen. It doesn't have access to that money, and therefore it can't afford to continue operations. Bloomberg's Ian Marlowe joins us from Hong Kong to talk about this continued crackdown on democracy. And I guess, Ian, this is what this is, right? Because we're talking about a pro-democracy media organization.
Yeah, Apple Daily, the sort of the most popular pro-democracy opposition newspaper in the city, has been under mounting political pressure for months now. I mean, they've been raided by police before. Their owner, Jimmy Lai, is currently in jail on charges for attending an unauthorized protest. And late last week, 500 police officers marched into the headquarters of the Apple Daily newspaper, and 3 of their top editors and their chief executive and publisher were arrested under the national security law, which China obviously imposed on the city last year. So at the moment, there's a lot of questions because this is the first time authorities here have used the national security law to arrest journalists. They previously said this law was only for a small minority of criminals. They'd be going after people who had violated the law. They were saying it was about riots and maintaining peace and stability in Hong Kong. And now we have essentially one of the largest opposition newspapers in the city being shut down because its owners can't access more than 500 million Hong Kong, roughly about nearly 70 million US, in funds that they have in the bank. So at the moment, they don't know how to pay staff. Suppliers and others can't transact with them. They can't put any money in their accounts. So at the moment, they're kind of being forced by the government into effective bankruptcy here.
All right, it's a story we will continue to watch. Thank you so much to Bloomberg's Ian Marlowe in Hong Kong. I do want to take a quick check now on some stocks moving in pre-market trading here in the U.S., beginning with some M&A action on this Monday. Raven Industries, which is an industrial agriculture products maker, is higher by 47% or so in early hours after CNH Industrial agreed to buy the company for $58 a share, around a 50% premium to Friday's closing price. Another stock surging in early hours is Torchlight Energy. This is one of the meme stocks that is front and center now. It once again was touted on Wall Street Bets as a potential short squeeze, and as a result, traders bidding up those shares, they're higher by about 42%. As I was mentioning, though, Bitcoin is under some pressure today because of fears around a mining crackdown in China, and as a result, some cryptocurrency-tied stocks are also under pressure in early hours. MicroStrategy, one of them, lower by about 6% before the bell, Francine.
Yes, so much going on that actually warrants a little bit of our attention. Now, coming up next, we'll look, of course, at the reflation trade. We'll get yields with Patrick Armstrong, Plurimi Wealth Chief Investment Officer. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman, London. Matt Miller and brilliant Katie Lyons in New York. Now, joining us to talk about the souring of the reflation trade is Patrick Armstrong. He's Chief Investment Officer at Plurimi. And Patrick, when you look at some of the metrics, it's very clear that the Fed pivot means that the markets are a little bit unsure about how to price things in. When will investors actually get a better handle on the fundamentals and what the economy does?
Yeah, I don't think they're trading off the economy so much. It's trading off that the Fed in 2 years is going to hike rates a couple of times. Half of them expect, and the other half aren't really pricing that in yet. So I think the market's really gone from reflation, the Fed's going to look through everything as transitory, to essentially being asleep at the wheel for the next 3 years, to where they've woken up where a lot of the Fed is going to pay attention and maybe the inflation isn't necessarily transitory. I don't know if the market reaction makes sense to me. I suspect the Fed would not have anticipated this, and therefore a significant chance they sort of changed the narrative this week, where they really, Powell may want to say, he always says don't look at the dots, but I think he may stress don't look at the dots, listen to what we say. Bullard came out a little bit more hawkishly on Friday and even said about a 2022 hike. And I think all of the Fed docs make sense, but totally inconsistent with really what the Fed has been trying to achieve over the last 9 months, which is create reflation.
Yeah, I mean, but also pretty insignificant, right, Patrick? I mean, half a basis point by the end of 2023, that's a long time away in this kind of economy. So Can't we really take it with a huge grain of salt?
I think we should be taking it with a huge grain of salt, and every reflation trade basically just got thrown out the window on Thursday and Friday this last week. And I think it's a relatively easy story for the Fed to take back, exactly just putting it as you did, that these dots are 2 years down the line. We have to hold our hands up because we have no idea what we'll be doing in 2023 because there's so many things that'll happen between now and then. But the Fed just really wanted to ease the signal that eventually all this free money, zero interest rates, buying billions of bonds will end at some time. And I thought that was probably a pretty mild way to show that things may eventually change. But the market is throwing out all reflation trades on this.
But it probably won't end soon, right? Because now it looks like central banks, the big ones, are starting to try and position themselves. The ECB says their stimulus is going to last at least as long as the Fed, which has helped them get the euro down to 118. I'm wondering if the reflation trade still has room to run. I got this great chart from our MLive blog. Cormac McMullen put it together, and for our listeners on radio, I'll walk you through what it shows us. This reflation trade, which started off in November, and here is shown as the MSC All-World Value Index divided by the All-World Index. It took off and rose to 18%. Now we're back down to about 9%. So it's about halfway what we have, halfway back down what we have climbed since November. Is this a good point for it to, I mean, is the deflation of the reflation trade kind of on pause for now?
It's on pause, and it's going to come down to the Fed. They're going to establish what they want their narrative to be this week. I expect they're going to come out quite dovishly, and you're going to get some of those reflation trades put back on. If the Fed comes out and all parrot what Bullard said on Friday, we probably have further downside because I've been owning banks. I own Goldman Sachs, I own Citigroup, and it's part of the reason I own them is I expected a steeper yield curve and that it would improve their profitability. I expected commodities to continue to get bids because the Fed would let inflation run hot. And I still think that's their game plan. I don't think the whole world gets out of this without basically massive monetization of debt, very strong nominal growth. I don't see how we get away from that with the debts and the deficits we face. So I expect that to be a pivot in the narrative this week. But if that doesn't happen, Thursday, Friday are probably what we've got for the next few weeks.
All right, thank you so much, Patrick Armstrong, CIO at Plurimi. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Happy Father's Day, Matt Miller. Belated Father's Day. Now let's get straight to the Bloomberg First Word News. And the two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Now, Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election. President Macron's party taking 11%. The turnout, an estimated 32%, was really at an all-time low. One recent survey showed many citizens didn't even know what the election was for. Now, some of Japan's biggest private employers will offer on-site vaccinations for staff from today in an effort to boost the country's slow vaccine rollout. Elsewhere, Russia, Germany, and Portugal reported more cases of the Delta variant. Canada, meanwhile, said its border with the U.S. probably won't reopen until 75% of its population is vaccinated. And a blank check firm backed by billionaire Bill Ackman is buying 10% of Universal Music from Vivendi for about $4 billion. Ackman's SPAC, Pershing Square Tontine Holdings, says the transaction values the home of Taylor Swift and Billie Eilish at $42 billion, including debt. And some breaking news, China's asking banks and Alipay not to get involved in crypto operations. Matt, this is a story that we've been following closely, not because of this, because this just broke, but actually over the weekend, there were a couple of regulations in order to keep control also of mining because it's not considered green enough by China.
Wow. So China doesn't, if China doesn't think it's green enough, then it's not green enough for anybody. I thought it was also interesting that we see at the same time a number of unicorns in China, in Hong Kong, that are getting big, billion-dollar valuations, and they're crypto exchanges or fintech that involves crypto. So it does look like you've got up and down arrows there.
And the down arrow for Bitcoin now.
Yeah, it certainly is.
Yes, for sure.
We'll have plenty more on Bitcoin. Coming up next, the Lloyds of London chairman. This is Bloomberg.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Well, this is Bloomberg Surveillance Early Edition. I'm Francine Lachman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, there is quite a lot going on, Matt, in the markets, and of course, it's a reflation trade that's not exactly going to plan, but it was interesting to get Patrick's thoughts on the fact that they've moved quite quickly, the markets, and he actually thinks they're probably moving too quickly. So I don't know whether they were mispriced before or whether they're mispricing how aggressively the Fed will move today.
Yeah, I think it's really interesting. We have a couple of Fed speakers also to watch out for, so there still could be some catalysts this week, but the gains that we've seen in this reflation trade have already been cut in half, as I showed you earlier. So maybe it's time for a breather and for the market to refocus. On the other hand, there's so many other things to watch, right? I mean, oil especially is important as we try and make a deal with Iran. The crypto situation is fascinating as China clamps down further, but a lot of the innovation is coming from China as well. So, and then you've still got the COVID issue, right? The Delta variant that has hit the UK so hard is now starting to rear its ugly head in the US as well. There are a lot of moving parts to kick off this week.
Yeah, a lot. So, Kaylee, how's it all playing out of the markets?
A lot to digest for a Monday morning. Matt Miller coming at us hard this morning. Although I would say in the equity market, actually, the older the session grows, the more positive it becomes. So all of those fears or worries the market could have that Matt was mentioning about, they don't actually seem to have them right now. The stock 600 in Europe was lower by as much as 0.6% and now is in positive territory to the tune of about 0.3%. And here in the U.S., futures are continuing to climb as well. NASDAQ 100 futures right now up by about 0.6% or about 85 points. And in the bond market, the U.S. 30-year yield actually fell below 2% earlier on in the session. Now it is climbing once again, and actually as a result, we are seeing the curve steepen just a touch. Right now, the spread between 5s and 30s sitting right around 115 basis points. And then, of course, as Matt was talking about, that crypto crackdown in China, both when it comes to mining and then, of course, the headline just crossing that China is asking banks and Alipay not to get involved in the crypto space. That is weighing on sentiment, with Bitcoin now just around $33,000. That is the lowest level since January. And of course, with Bitcoin moving lower, it is dragging on some crypto-tied stocks in pre-market trading. You have Marathon Digital, MicroStrategy, Riot Blockchain, all down 6% or more. And then Coinbase, of course, is a crypto exchange, and it is also down by about 2%, Francine.
Kelly, thanks so much. Now, the insurance market has been at the epicenter, of course, of the coronavirus crisis, paying out billions of dollars to bail out everything from cancelled sports events to giant concert tours. Now, Lloyd's of London, the world's largest insurance market, has secured an additional £650 million of cover for its central fund. That's to protect against its underwriters being overwhelmed by similarly unexpected events. We're delighted to be joined by Bruce Carnegie-Brown, chairman at Lloyd's of London. Mr. Carnegie-Brown, thank you so much for joining us. When you look at how the pandemic has affected Lloyd's of London, but also the insurance market in general, what will its legacy be?
Well, as you rightly say, this has been a very large event for the insurance industry, and at Lloyd's, we've announced that we will pay claims in excess of £6 billion related to the pandemic, and the largest of those have been around event cancellation issues. Increasingly, of course, what we're focused on is how can we support our customers in future pandemics, but also more broadly across other systemic risks like cyber and climate. And so one of the big themes that we have post this pandemic is working more closely with governments to provide solutions to these kinds of challenges. So interestingly, statistically, I think the total resources of the non-life insurance sector globally are about $2 trillion to pay all of their claims. But what the IMF said in 2020, the governments pumped in some $14 trillion to support their economies. And so you can see that the scale of the challenge around the pandemic has been much too large for the insurance industry alone to bear. And so I think creating a collaboration between the industry and government is going to be key to addressing future systemic risks.
So can you give us an indication of what you think the final bill for COVID is? Is it too soon to actually see how much this will cost Lloyd's of London and some of the underwriters?
No, so we think our total bill will be of the order of £6 billion now. The key now is, of course, that many of these covers are not available to our customers going forward, and we need to reintroduce them in order to support our customers in building back resilience into their business models as they try to reopen for business.
Are more people asking for insurance against future pandemics? Is that something that you can ensure?
Yes, well, in fact, the answer is that we did provide insurance cover. So after the SARS epidemic, we produced a report in 2008 that's been on our website since then, which looks enormously prescient for the issues that the economies around the world have subsequently faced through this pandemic. And we put in place products to try to support our customers, but nobody bought them. So one of the challenges around this is not just having the products available, it's behavioral activity on the part of our customers. And what we find is that where events are very remote in terms of their perception, even if the impact is very high, people don't buy the insurance covers. Now, clearly, pandemic is now no longer regarded as a remote event, so people are interested in buying pandemic covers. But it's not just an issue of whether they are available, they also need to be affordable for our customers. And because of the size and scale of this kind of issue, this is why we need a partnership with government. And so we put out a white paper last summer on suggested structures that we could work with, and we've been engaged with more than 25 governments around the world to look at a partnership that would help customers be able to buy this product at an affordable price to protect themselves from future claims.
What kind of pricing do you expect? Because, of course, it's still remote, right, Bruce, that we have another global pandemic that forces businesses to shut completely down. On the other hand, it's got to be incredibly, impossibly expensive to pay off if everybody takes it.
Yes, so that's exactly what we need to look at, is that balance between availability and affordability. And we're running some test pilots at the moment around certain products with customers to see whether what we're offering is interesting to them. I mean, clearly we all have a limited budget around what we can spend to buy protection from the risks that we take. And so there is a prioritization issue here. And do we need to divert a premium that we pay for risks that we currently insure to buying pandemic cover, for instance, if we think that those kinds of risks are now looming much larger on the radar screen. So there's a huge behavioral issue here. I mean, if you take an example away from the pandemic and you look at windstorms in the United States, hurricanes blow pretty regularly every year in the southeast of the United States. but only 1/3 of the economic value that hurricanes destroy is actually insured even today, despite the regularity of these events. And what we know is that the most expensive real estate in the world is all located on waterfronts, and waterfronts are most exposed to hurricanes. So there's behavioral issues that also need to change here to build resilience into our economic models.
Well, Bruce, that brings me to climate change. To what degree are you seeing demand for insurance against climate events move higher?
So we think the total premium value for climate-related events is increasing year over year. We're doing a lot of that at Lloyd's today. But again, it's important that there's resilience alongside climate change. So our mantra really is trying to support our customers as they transition to more sustainable business models. We're absolutely committed to the UN sustainability goals for a net zero by 2050. And we've announced that from the beginning of next year, we will not insure new thermal coal projects, Arctic drilling or oil sands projects, because we think those have the highest negative impact on the world's climate. And similarly, we're producing products to support renewable energy, particularly things like wind and solar.
Aside from climate and the threat of another pandemic coming potentially down the line, what other kinds of risks are people primarily looking to insure against?
So cyber is I think the third of the systemic risks that I call out. So pandemic, cyber, and climate, and cyber risks are also growing as a result of the pandemic. Much greater adoption, of course, of cyber ways of working through the pandemic, and therefore a need to adopt and adapt policies. So a good example of that would be typically you're not allowed to use your home under your standard home insurance policy as a place of work, and the insurance industry has moved to adapt its policies to allow for remote working. But there is an increasing evidence of ransomware, for instance, that's coming through in the last 12 months that's causing very substantial claims in the insurance marketplace against the provision that we have. And it's also important, just as you know, if you have a sprinkler system in a factory, it reduces the chance of fire. If you have a burglar alarm, it reduces the chance of theft. We've got to try to build a better engagement with our customers about reducing the incidence of the risks that they face. And of course, if the risk goes down, so will the costs of the cover.
Bruce, thanks so much. Bruce Carnegie-Brown, there, Chairman at Lloyd's of London, joining us today. Now, coming up, Bitcoin under pressure after a crackdown in China. We'll talk cryptos next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacroix in London and Kaylee Lines in New York. Now, China continues to crack down on cryptos, now asking banks and Alipay not to be involved in crypto operations. Bitcoin is, of course, struggling amid a risk-off mood in the market and the ongoing issue with mining in China as well. Joining us is Bloomberg's Eddie Vanderwalt to talk about this, as well as some other things if we have time, but let's focus on cryptos first. Eddie, there's been a drop in the hash rate. So what does that mean for the price of Bitcoin?
I know. Yeah, I know. It sounds like a really scary metric. All it really tells us is that, you know, miners are shutting down their computers and they're mining less Bitcoin. But what this actually means, it doesn't mean that we're going to see Bitcoin into the market, because the fundamentals of Bitcoin doesn't quite work the same as, you know, shutting down a copper mine, therefore you get less copper production. The rate at which Bitcoin is produced is fixed by the algorithm. So therefore, you know, just shutting down miners just means it becomes easier to mine Bitcoin. It doesn't mean that we will see less Bitcoin coming to market. Really, what we're seeing, this drop in price, is really got to do a lot more just with the risk-off mood generally in markets. Now, the risk mood has improved a little bit over the last hour or so, but not in cryptocurrencies.
But Eddie, it was my understanding that China, apologies, I always lose my voice when talking about cryptocurrency, that China was never that into cryptocurrency, so they always, you know, tried to stem the flow. Well, the fact that it's now moving the price, is it because they're aggressively trying to kind of stem speculation?
Yeah, look, the Chinese government has never been big on cryptocurrencies. The Chinese government has never been big lovers of cryptocurrency. The Chinese people, however, have adopted it, you know, at a pace probably that outstripped everybody else. We have seen, you know, the Chinese consumer and the Chinese investor going after cryptocurrencies. And a lot of the mining capacity has been, you know, located near these big hydro facilities in China. So what we are seeing, you know, is that as the government cracks down on it, that definitely has a knock-on implication for price.
Eddie, to what extent are you paying attention to the technicals? Does the death cross really mean anything?
The technicals for me is the most important thing in cryptocurrencies, because it's really hard to price cryptocurrencies on the basis of fundamentals, on the basis of inflation expectations, on the basis of almost anything else. But because cryptocurrencies is almost a pure investment play. Therefore, you know, technicals which try and measure investor sentiment, you know, in some sort of pure form removed from the fundamentals, I think it's really interesting to look at. I don't know that the death cross is going to matter that much. What I will say is that this drawdown in crypto has been a lot smaller than we've seen in the past. We're only down about 50% from the all-time highs. Previous drawdowns, we've gone as much as 80%. So, as you know, as crazy as it may seem, even with this drawdown, it seems as though crypto seems to be maturing and seems to become a little bit more just stable and you know, worthy of mainstream adoption.
Well, and you've got a great chart. I'll recommend to our both our television viewers and our radio listeners to check out the MLive blog, MLIV Go on the Bloomberg, to look at Eddie's chart there. You're also talking, Eddie, a little bit about gold here. And in fact, a number of MLive contributors have weighed in on gold. We saw a great rally in the precious metal and then a drop around the Fed move. What's the short to medium term future look like for gold?
Matt, yes, the air has just kind of gone out of that gold rally a little bit. I think what we're seeing here is that we're seeing you know, hopes that the Fed is finally starting to talk about tapering. We're just seeing that sort of hawkish noises coming through. But really, what you want to be talking about for gold at the moment is the dollar. If we look back at 2013, 2014, in the previous you know, tapering cycle, what we saw was the dollar turned first, gold turned immediately afterwards, and that became the major trade for gold going forward for a number of years, and I think that could be the case here.
Eddie, I know that there are two actually Fed presidents talking today. Are they going to try and temper some of these market moves, or is this what they wanted?
You know, I think we haven't seen extreme moves. I don't think that they will come out all guns blazing saying, listen, you got it wrong. Because I think there was perhaps the understanding that Bullard came out on Friday, you know, and just ramped up the market's expectations for a slightly more hawkish Fed. Now, I think there's going to be a lot of management this week. We're going to get, I think we've got 16 Fed speakers this week. It's a really busy week for Fed speakers. So, you know, there will be some management, but I don't think they're going to completely row back and say, listen, you got it wrong, because the market's move just hasn't been that extreme yet.
Eddie, thanks so much. Eddie van der Walt there, of course, from our MLive team, looking at everything crypto, treasury, and the flattening yield curve. Now, coming up throughout the day, Bloomberg Live Qatar Economic Forum, rethinking the global economic landscape through the lens of the Middle East. Now, we have a really all-star lineup for you. Speakers include the WTO Director General, Barclays Chief Executive Jess Staley, and Bridgewater founder Ray Dalio. So we'll look at that, and coming up, we'll have plenty more on Iran. We understand that there's a press conference by the president-elect, President Raisi, holding a press conference in Tehran as we speak. Plenty more on that shortly. This is Bloomberg.
انجام گرفت. این حضور پیام‌های مختلفی داشت.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman, London. Matt Miller in Berlin. Kaylee Lyons in New York. Our Tom Keene now joins us. He's co-anchor of Bloomberg Surveillance. And I know, Tom, you have some great guests and then some great charts for us as well.
Well, Tony, we're perfect today. We
Happy
booked Tony
Monday.
Cosenzi before Friday blew up. And to have the gentleman from PIMCO with us today is really perfect with what we're seeing in the bond market. Ben Emmons will join as well on how this all links into Fed policy. Really, really interesting. Francine, as many people have said, including George Saravelis, I've never seen markets like this. Where we are right now, Francine, after this natural disaster, the huge fiscal stimulus is absolutely original. and there's no other chart than the amount of cash sitting at the Fed. One of the indicators of this is ON, overnight repos, and the circles are just simply the different days recently where the amount of money sitting at the Fed ballooned up, and there it is out to a new high after the Fed festivities of a week ago.
Yeah, Tom, I mean, we're hearing a little bit later on, I think, from Robert Kaplan and James Bullard. I mean, they'll have to, and it's a really great chart. How will they position it?
This is really an important question, and you're dead on about the Fed speak this week. They're going to have to re-rationalize the message of last week, and Francine, critically, they're going to have to reset, as Bullard already has attempted to do. I believe it was on Friday. But what you saw on Friday, and with the markets up today, I'll tell you, the bond market is litmus paper for the global system now. It's tangible, and people are going to hang on every word of those Fed experts.
Yeah, they certainly will. Tom Keene, thank you so much. Sure. Co-anchor of Bloomberg Surveillance, starting shortly. I'm really looking forward to watching the program. Now, a look at what else we're watching today. Kaylee, what's on your mind?
Well, it's Amazon Prime Day today, Francine. Actually today and tomorrow, of course, the annual online sales event. Last year, it got bumped back to October because of the pandemic, and it is happening this year, as it traditionally does in June. Now, this could be a really big sales day for Amazon. Analysts over at Telsey Advisory said total sales could be as much as $12 billion over just the two-day event. That would be growth of about 16% compared to 2020. And our analysts here at Bloomberg Intelligence, Matt, say there will be a shift in what people are buying this year, a bigger push toward apparel and travel as the world reopens. But of course, people are still going to be looking to buy things for their home, buy electronics. I myself will probably be doing some online shopping after work, Matt.
I was looking yesterday for disposable baby bottle inserts. So my
That's very specific.
shopping habits are changing drastically in terms of what I buy on Amazon.
To see your algorithms.
I am, exactly. I've gone from, motorcycle clutch tools to baby bottle inserts. I am watching UK supermarkets. Now, I make fun a lot of how much Britons care about their supermarkets, but I'm only joking. I also care. You know, I have bought BLTs at Marks and Spencer's. I have bought, TV dinners at Tesco's. Every little helps. And I have bought, honestly, the best New York cheesecake in the entire world at Waitrose, but Morrison's is the one in play right now. Clayton Dublier and Rice making an offer there reportedly for $5.5 billion, and this supermarket could be in play. It was a 32% gain right now, so a massive boost to the FTSE and the stocks and the stock 600, and it's definitely one to watch because there could be more consolidation in this exciting industry.
Yeah, I mean, it's a great story, Matt, and it's amazing that they just after 3 days said, actually, no, it's not the right price. Matt, I hope your algorithm for Amazon is better than mine, because I still get, baby news, and my youngest is like 7 years old. So good luck with that. I'm looking at cryptocurrency, and this is, without a doubt, for me, one of the top stories because of China's involvement in cryptocurrency. So just a couple of minutes ago, I think about 15 minutes ago, China has asked Alipay and banks not to get involved in crypto operations. And then last, I would say, 7 days, I learned DeFi, and I've learned exactly what some of the other things. Hash rate is.
DeFi, you mean?
Commentators. DeFi, I say it DeFi, the European style, of course, mispronouncing it. So DeFi, the so-called decentralized finance, is something that we've been talking about over the last week, and China getting a much stronger stance on this. It's basically the apps that let people lend, borrow, trade, and take out insurance directly from each other. And the other one, which I'll also mispronounce, is hash rate, the computational power used to mine Bitcoin and the like, and China's having a crackdown on that as well, Matt.
Yeah, I think we all understand hash a little bit better than DeFi. Sometimes we use Wi-Fi when we're talking about Bitcoin as well, no?
I also say Wi-Fi. We'll have plenty more, of course, on Bitcoin, on the markets, on the yield curves, on Bloomberg. This is Bloomberg.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
We still see there being more to go in this restart narrative.
It's still being affected by concerns about COVID.
The biggest risk for me is that I underestimate how much inflation is going up.
The Fed doesn't know either when this transitory notion is going to go away.
The Fed has to be very careful about its communications, not just verbal communications, but all types of communications.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. Good morning on an unprecedented Monday. There is no other way to put it. The bond market and the linkage, the correlations into equities, commodities, and the rest is absolutely extraordinary. Lisa Abramowitz, Matt Miller in for John Ferro, which is a good and beautiful thing. Matt Miller's surviving Father's Day by all reports that we can.
How about Tom Keene?
No, I didn't survive it.
Okay.
Lisa, the 30-year bond, briefly in the Asian morning, under 2%. Stunning.
Stunning because basically people are pricing in the ramifications of a hawkish Fed before the Fed comes through on even being hawkish. A couple of members coming out and basically indicating that they'd be willing to raise rates, and the market extrapolates down into the future of slower growth and lower bond yields. Exceptional moment, Tom.
Want to go to the research board now? We've got tons of research to verbal to you this morning. That's what we do here. We summarize global Wall Street. Stephen Major Dyer and the team at HSBC out with a terse note. Both Abramowitz and I independently notice this note. We maintain our 1.0% forecast for 10-year treasuries. And then on the movement, the elasticities we're seeing, the new policy moves more slowly than a Taylor rule, but it does move.
Yeah.
The underlying inflation trend is likely to be benign based on GDP and PCE projections. Lisa, I go to GDP, and the turmoil we're seeing now is a guesstimate of where GDP is going.
The guesstimate of the ramifications of the frictions in the labor market, the ramifications of higher gas prices, higher prices in staples, leading to lower purchases, the dreaded S word, the pendulum of stagflation, Tom.
Well, it is in a new kind of stagflation. Well said, frankly. Matt Miller, I really want to go to what this means for Europe. I mean, it's sort of we're separating away hawkish central banks from Lagarde alone. Is that it?
I think Lagarde and the ECB have done a great job playing this to their advantage as you see a euro coming back down to 118. My question is, does the Fed strike back with the speakers today? You know, we're going to start seeing a lot of people are talking about the big central banks jockeying for a better position in terms of currency.
It is absolutely, again, I really want to emphasize the market coverage worldwide, absolutely extraordinary right now, and we'll really sit on it this morning. Tony Crescenzi will be joining us from PIMCO, I believe, in this hour. Let's do the data right now. Matt Miller, help me out here. You mentioned euro, a 119 exact, yen weaker as well, 110.11, and the dollar really not breaking out, Matt Miller, is it?
It isn't, but we've seen the euro and the pound come down pretty substantially over the past couple of sessions. So what you see here is just could be a dead cat bounce, as David Buick used to say. The point is the euro's not trading at $1.22 as it was pre-Fed meeting last week.
Equities surge in were weaker in Asia, and now they surge up 0.5%. SPX up 20 points. Dow, we do the Dow futures for John Ferro.
He's
up
grateful.
200 points, 33,355. NASDAQ, well, was leading the way, not so much. much right now. Bitcoin, I should point out, 32,000, 33,000 right now. Lisa,
that's fascinating.
We need a brief.
Yeah, we do need a brief, and we will get to Bitcoin, I promise, Matt Miller, later on.
Yes,
I meant Dow futures. I thought Dow futures were fascinating, not Bitcoin.
Let's move on to what we're expecting today. We're expecting a number of Fed officials to come out and speak. Jim Bullard, in particular, of the St. Louis Fed, among them, which should be interesting following his hawkish discussions on Friday. Also, John Williams of the New York Fed, as well as Robert Kaplan of Dallas. These remote or these virtual events by the Federal Reserve, possibly giving some color to the dots raised forward, bringing forward some of those rate hikes. 1:45 p.m., President Biden is going to be meeting with financial regulators. Interesting to see the focus on regulators and global climate change, how much they are going to weigh in on this. That is his connecting force here. What kind of threat to the financial system could global warming be? An interesting conundrum, especially at a time when it's not a clear link and we still have a lot of other issues to work out within the financial system. And today we have the Bloomberg Qatar Economic Forum. Very interesting roster of speakers, including Barclays' Jess Staley, Ray Dalio of Bridgewater. How much do they recognize the new regime, the paradigm shift that we're seeing reflected in markets, the deflating of the reflation narrative? How much do they buy into this, and how much are we going to hear from Ray Dalio? Cash is still trash, and we're going to get inflation pick up dramatically here, whether the Fed takes a more hawkish tilt or not, Tom.
Lisa, thanks so much. And we'll dip into the coverage there from Doha this morning. I know Mr. Bloomberg leading off that Bloomberg Forum on this Monday. Right now, David Page with us with AXA, investment managers, head of macro research. David, there's a huge divide out there. There's people looking out for higher yield, elevated inflation, and others who simply say no. Which is it?
We think yields will move higher, and we think it'll probably happen over the next 3 months or so, certainly from the depressed levels we find ourselves at the moment. I mean, the story on inflation, I think, is a transitory one, certainly in the short term, in the sense that we are seeing this big spike, and we do expect that to roll off, and we think there'll be increasing evidence that that's rolling off as we move into, the September months and after the summer, and that will add to the story. I think the key is, though, the Fed isn't really that worried for now about what's happening at the very short end over the next couple of months in inflation. It's really trying to guess what's going to happen towards the end of 2022, what's going to happen into 2023, what would happen into 2024 if they don't move. When you're thinking about dots moving, into 2023 rather than 2024, they're anticipating inflation much further out, not the next few months. And I think that's the key issue here. And I think once the Fed repurposes some of its messaging, I think that's going to come through both in real yields and to some extent in break-evens.
David, what could, though, trigger the increase in yields? If it's not a more hawkish Fed, the idea that the Fed itself is starting to see inflation pick up, what could possibly convince the rest of the market that they are wrong, especially if the Fed is showing a willingness to try to tame inflation should it rear its head?
Well, I don't think the Fed is suggesting that. I mean, there was a reaction that, the Fed only increased its inflation forecast to 2.2 from 2.1, and that's what led to this whole shift in the dots. And so the overshoot that the Fed was looking at for 2023 wasn't as much. And I think that's wrong. I think what the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation that is going to be persistently higher if they don't put themselves in a position where they can start to restrain that. And that's perfectly sensible from a central bank's perspective. They have extreme accommodation at the moment. Rates are as low as they can be. The QE program is extensive, and they're still not talking about tapering that, and we don't expect them to until December. There's a huge stimulus going through. We can see the problems it's causing at the short end of the market with some of the liquidity positions out there, and I think the Fed needs to work out how it's going to retrace some of that. So I think that's the story that they're going to communicate. That's where we're coming through at the moment.
So is this what we see in treasuries right now, what we see in the 30-year coming back below 2%, is this investors all getting out there looking for duration? Are they searching for convexity to try and limit their exposure to interest rate changes?
I think to some extent there is a repositioning come through, and I think also there is a global factor here as well. I mean, we're still seeing, as we've talked about in previous sections, an ECB that's taking advantage of the international situation. There's elevated purchases coming through from the ECB. German bond yields are still trading at negative. And so you still get quite a